Imagine waking up one morning and realizing the world's second largest economy is quietly pulling strings behind the scenes, not with armies or speeches, but with cold, hard cash. That's exactly what's happening right now in China. State-owned banks, the giants of Beijing's financial system, have been aggressively buying up US dollars in the onshore market. Why? To keep the yuan from rising too fast, too soon. And trust me, this isn't just some boring currency story, it's a high-stakes game that could ripple across global markets, your wallet, and the future of international trade. Here's the setup. The yuan recently surged to a 14-month high, a level that caught traders off guard. Normally, when the yuan strengthens, it signals confidence in China's economy. But too much strength too quickly can be dangerous. It makes Chinese exports more expensive, threatens growth, and shifts the balance of power in trade negotiations. So what did the state banks do? They stepped in, scooping up dollars and holding onto them, not recycling them into swaps like they usually do, but stockpiling them, tightening dollar liquidity, and raising the cost of betting against the greenback. In other words, they made it more expensive to bet on the yuan's continued rise. Think about that for a second. This isn't just intervention, it's strategy. By refusing to recycle those dollars, the banks send a clear message: we'll let the yuan climb, but only at our pace. Traders immediately felt the squeeze. Back-end dollar-yuan swap points dropped, signaling a deeper negative carry for anyone holding long yuan positions. Translation: if you were betting on the yuan to keep soaring, suddenly your position got a lot more expensive to maintain. That's Beijing flexing its muscles without saying a word. And here's where it gets fascinating. This move isn't about reversing the yuan's upward trend. Sources close to the action say it's about moderation, smoothing the rally, not killing it. It's like a coach letting the team run, but slowing them down just enough to avoid burning out before the finish line. The yuan still sits strong, but the pace is carefully managed. And that tells us something critical about China's mindset right now. Stability is king. They want growth, they want confidence, but they don't want volatility. Zoom out, and the timing couldn't be more dramatic. Global investors are watching every tick of the yuan because it's not just a currency, it's a barometer of China's economic health. After years of trade wars, pandemic shocks, and geopolitical tensions, a strong yuan could signal resilience. But if it rises too fast, it risks undermining the very export machine that powers China's economy. So the state banks are playing referee, blowing the whistle when the game gets too heated. Let's put this in real-world terms. Imagine you're a European company buying Chinese electronics. If the yuan skyrockets, suddenly your costs jump. That could push you to look elsewhere, maybe Vietnam, maybe India. Multiply that across billions of dollars in trade, and you see why Beijing is so sensitive. Every tick of the yuan impacts factories, jobs, and global supply chains. And by soaking up dollars, the banks are essentially saying, we'll keep our goods competitive, thank you very much. Now, here's the twist. This isn't the first time China's state banks have intervened, but the scale and style this week were unusual. Normally, they smooth things out quietly, recycling dollars into swaps. This time, they held onto them, creating a tighter dollar market. That's bold. That's deliberate. And it shows just how far they're willing to go to control the narrative. Traders are calling it one of the strongest efforts in recent memory to rein in yuan strength.
And the ripple effects. Huge. Dollar liquidity in China gets tighter. Long yuan bets become more expensive. Exporters breathe a sigh of relief. And global markets take note. Beijing is still in control. It's a reminder that in the currency wars, China isn't just a player, it's the referee, the coach, and sometimes the rulemaker. So what does this mean for you? If you're an investor, it's a warning shot. Betting against Beijing's will is risky. If you're a consumer, it's a reminder that the price of your next smartphone or electric car might be shaped not just by supply chains, but by invisible hands in China's banking system. And if you're just curious about the future of global power, it's proof that money moves faster than politics, and sometimes more decisively. Here's the emotional punch. We're living in a world where currencies are weapons, and China just showed us how sharp theirs can be. The yuan's rise is a story of confidence, but the bank's intervention is a story of control. Together, they paint a picture of a nation determined to manage its destiny, $1 at a time. And that's a story worth paying attention to. If you found this breakdown eye-opening, if you felt the tension of watching a global power flex its financial muscles, then don't just scroll away. Hit that like button, drop a comment with your thoughts on whether China's strategy is genius or risky, and subscribe for more deep dives into the hidden battles shaping our world. Because this isn't just news, it's the future unfolding in real time, and you deserve to be part of the conversation.